Welcome to Sectors Up Close. I'm Elena Casas. Today we're talking US consumer staples with Satya Pradhuman, Director of Research at Cirrus Research. Consumer staples is a traditionally defensive sector that has benefited from a squeezed consumer and recession worries, as well as a broader market move away from pricier sectors such as tech. The S&P 500 Consumer Staples Index has risen about 16% this year, but half of those gains have come just since mid-July, massively outperforming the wider market in that 10-week period. Industry bellwethers Coca-Cola and Colgate have seen gains of 21% and 29% respectively, as investors seek to shore up their portfolios against a potential slowdown in the world's biggest economy. Walmart, which makes up 12% of the index, is up by 50%. So, where next for this previously out-of-fashion sector? Let's ask Satya Pradhuman of Cirrus Research. Satya, hi. Clearly we've seen consumer staples benefit from the US consumer be a bit squeezed in recent months, but does the recent bumper 50 basis point Fed rate cut change that a bit? Won't the consumer be feeling a bit more confident?
Yes and no, as always, I guess. I do think that the cut in rates is quite favorable. It changes the composition of costs to the consumer. So, for instance, mortgage payments are likely to be lower, especially as consumers really strike new contracts. Insurance payments and the like. All these things are starting to become, let's say, less expensive. That said, the buildup of expenses and inflation through the last few years, it's hard to shake that quickly. And so we think the consumer will remain squeezed, as we called it in our report. They'll be penny pinching. The idea is that the superstores, the Walmarts of the world, are going to play favorably and continue to.
Looking more broadly at consumer staples to start with, though, how much is this about defensiveness? Are you essentially pricing in a recession if you bet heavily on this sector?
Yeah, we believe that you've gone through the reopening cyclical snap. The U.S. consumer, the jobs market has been incredibly resilient given the tightening cycle we've seen. At this point, we think that you are likely to see somewhat of a slowdown. That said, the jobs data is quite powerful, and so this lurch to being too defensive may be not the best idea. We think that this is a much more even-keeled economy, and as a result, some of the focus on better valuations matter. The profit cycle just bottomed. If those comps continue to move favorably, that's a good investment world.
You mentioned valuations. Of course, investors have been looking for value as they try and broaden the market rally beyond tech. But after the recent run-up, are these stocks still value?
That's a great question. I believe that the valuation comparisons, let's say 6 months ago, were much more compelling. That said, if you look more broadly to the market, the real, I think, nervousness right now is more lodged in whether a near $3 trillion company can continue to accelerate its growth, which is hard to see. So in terms of relative valuation, the consumer spaces that are working should continue to. In fact, if the market gets more valuation sensitive, I do think the retailers, the bulge, the sort of super value stores, those stores will still hold their own.
Let's start picking and choosing a little bit then, Satya. Within this space, we've got retailers, we've got consumer goods staples, food manufacturers, drinks companies. Which are your favourites?
Well, we remain in the low-end, mid-end retailers. We think that the sort of food, beverage companies, their margin pressures will remain. So we think you need to be more selective there. And the final point is, I wouldn't race to a recession trade here. For 2 years now, you've had, sort of like big voices calling for the slowdown. Underneath this, when you look at the jobs data, it's really hard to make that sort of recession statement, I think.
You mentioned the margins for some of these companies, notably drinks. Companies including Coca-Cola and Heinz have proved in the last couple of years that they have substantial pricing power. They've kept raising prices and consumers have continued to buy. Are they running out of headroom there?
We think so. When you look at the comparison, the pressures on the consumer, I think the ability to push prices further is just not in the cards. And so a lot of these firms are now on their heels, I think, in terms of pricing power. One benefit, though, is the fact that a lot of the input costs for these consumer-based firms have really slowed. And that's been a benefit. That said, that's been 2 years now. So the market sort of rewarded those firms for the improvements. And at this point, I think they are slower growing areas when you look at the overall marketplace of what you could invest in.
Satya Pradhuman of Cirrus Research, thank you so much for joining us. Well, that's your roundup of the consumer staples sector. I'm Elena Casas, and this is Reuters.